Introduction to Time Value of Money, TVM. The time value of money, TVM, is a foundational principle in business finance. It emphasizes that the value of money changes over time. This concept stems from the basic logic that money today is worth more than the same amount in the future because of its potential earning capacity. In simpler terms, a naira in hand today can be invested to earn interest, whereas a naira received in the future cannot be utilized immediately. TVM is critical in business finance as it supports decisions in investment evaluation, capital budgeting, loan and lease structuring, business valuation, retirement, and personal savings planning. Understanding TVM allows financial managers to assess whether a project is worthwhile, determine the true cost of borrowing, and develop strategies that maximize wealth creation over time. Core components of TVM. To apply the time value of money effectively, several key components must be clearly understood. Present value, PV. The current worth of a future sum of money or stream of cash flows given a specified rate of return. Future value, FV. The amount of money an investment will grow to over a period of time at a given interest rate. Interest rate, R, 0.0. The rate at which money grows due to investment or borrowing. Number of periods, N, dot. The number of time intervals, usually years or months, during which compounding occurs. Payments, PMT. Regular cash flows involved in annuities or loan repayments. Understanding these variables is essential in evaluating investments, loans, and financial options. They also form the basis for formulas used in calculating the value of money across time. Calculating future and present values. Let's look at the two most important TVM calculations. Future value FV. FV answers the question, period. If I invest this amount today, what will it be worth in the future? Formula. Point. FV equals PV times 1 plus R to the power of N. If you invest 200,000 naira for 3 years at 10% annual interest, FV equals 200,000 naira times 1.1 to the power of 3 equals 266,200 naira, 1.1, cubed equals 266,200 naira. Present value, PV answers. What is the value today of a future amount I expect to receive? Formula, point P5 equals FV divided by open parenthesis. 1 plus R close parenthesis to the power of N. If you expect 500,000 naira in 5 years and the discount rate is 8%. PV equals 500,000 naira times 1.0, 8 times 5 equals approximately 340,290 naira. Fractios 500,000 naira, 1.08, 5 approx 340,290 naira. These formulas help businesses and investors determine whether it's better to invest now or defer consumption for future returns. Annuities and perpetuities. TVM extends into annuities and perpetuities, which are critical in structuring regular payments like rent, salaries, pensions, and loans. Annuity. An annuity is a series of equal payments made at regular intervals. Ordinary annuity, dot. Payments are made at the end of each period. Annuity due, 0.000. Payments are made at the beginning of each period. Formulas. FV of ordinary annuity, dot. FV equals PMT times open parenthesis, the fraction, open parenthesis, 1 plus R, close parenthesis, N minus 1, close parenthesis, divided by R, close parenthesis, FV equals PMT times the fraction, open parenthesis, 1 plus R, close parenthesis, N minus 1, close parenthesis, divided by R, close parenthesis. PV equals PMT times the fraction 1 minus 1 plus R to the negative N over R. A business pays 100,000 naira every year for 5 years at 10%. PV equals 100,000 times divided by 0.10, approximately 379,079 naira. Perpetuity. A perpetuity is an annuity that lasts forever. Formula. Point PV equals PMT divided by R example colon. A business pays 20,000 naira annually forever at a discount rate of 5%. PV equals 20,000 times 0.05 equals 400,000. PV equals refract 20,000 naira 0.05 400,000 naira. This applies in valuing stocks, government bonds, and some pension models. Compounding and discounting techniques. Compounding is the process of earning interest on both the principal and previously earned interest. Annual compounding. Interest is added once a year. Semi-annual, quarterly, monthly compounding. More frequent compounding leads to higher returns due to interest on interest effect. Effective annual rate, EAR, reflects the actual interest earned or paid annually after considering compounding. Formula, EAR equals open parenthesis 1 plus R over M, close parenthesis, raised to the power of M, minus 1, where M is the number of compounding periods per year. Example, period. If the nominal rate is 12%, compounded quarterly. EAR equals open parenthesis 1 plus 0.12 divided by 4, close parenthesis, 4 minus 1 equals 12.55. EAR inserts 1 plus 0.12 divided by 4 to the fourth power, minus 1 equals 12.55%. Discounting is the reverse determining present value from a future value using a discount rate. This technique is vital in comparing projects, evaluating bond prices, and structuring future business payments. Business applications of TVM. TVM is used extensively in strategic financial decisions. 1. Capital budgeting. TVM helps evaluate long-term projects by discounting expected cash flows to their present values. Net present value, NPV. NPV equals present value of cash inflows minus initial investment. NPV equals text. Present value of cash inflows minus text. Initial investment. Internal rate of return. IRR. The rate that makes NPV equals 0. Used to compare profitability of projects. Second loan amortization. TVM determines equal installment payments over the life of a loan. Formula, PMT. PMT equals PV times R1 minus 1 plus R to the negative n power. This is critical in business borrowing decisions, e.g. bank loans, equipment leases. Third, investment appraisal. Investors use TVM to evaluate whether current investments will yield desirable returns. Fourth, bond valuation. Pricing bonds involves calculating the present value of future interest payments and the redemption value. TVM incorporates inflation to help businesses make realistic financial decisions. Nominal value, the stated amount of money, unadjusted for inflation. Real value, adjusted for inflation, representing true purchasing power. Fisher equation, dot. 1 plus I equals 1 plus R times 1 plus H. 1 plus I equals 1 plus R times 1 plus H, where I equals nominal interest rate, R equals real interest rate, H equals inflation rate. Understanding this relationship is vital in regions with high inflation, e.g. Nigeria. Excel and financial tools for TVM. Business analysts and students use various tools to simplify TVM calculations. Excel functions, FV rate, NPER PMT, PV rate, NPER PMT, NPV rate, value 1, value 2, PMT rate, NPII PV. Financial calculators tools like BA2 Plus and HP10 BII are designed for TVM calculations. TVM tables, pre-calculated factors for quick reference, less common today but still educational. Summary. The time value of money is the foundation upon which sound business finance is built. Whether you're managing cash flows, valuing investments, or making long-term strategic decisions, understanding how to measure and apply TVM is essential. This module provided a comprehensive framework from simple interest calculations to advanced applications like capital budgeting and bond pricing. By mastering these tools, students and professionals alike can ensure their financial decisions are time and value sensitive.